Hello, my name is Hazel Mullins, and I am a large animal vet and also a dairy farmer based in Cork. Being self employed is not easy. There's a lot of ups and downs, there's a lot of unknowns for me, but having Alpha Wealth by my side, I really feel like they have made a lot of my worries disappear over the last year. 2023 has been also a busy year because I got married in May, and I've also been undertaking a self-build with my husband for the last year and a half. We are nearly moving into the house. We are about a couple of weeks off, and it's a very exciting time, but it's also was a worrying time when I did give up my job and go self-employed. That was I going to be able to meet the payments on the mortgage? Was I able to finish the house? And luckily, with the help of Nick's advice and also the budget calculator, kind of put my mind at ease that yes, that perhaps I just need to cut back on certain other expenditures. And I'm very, very grateful to the team at Alpha Wealth.
Hello, everyone. Thank you very much for joining us today for this
Hello,
webinar.
my name is Hazel Mullins.
That's for business owners and senior managers. My own name is Nick Sharon-Ambus, and I'm the Managing Director of Alpha Wealth. Just while we're waiting for the numbers to settle, my colleague Ruth is just going to put up the first of two polls that we're just getting, I suppose, a bit of a reaction from yourselves for those of you that are listening live. So if you could just respond to them for the next kind of 10 seconds or so, as I said, then we'll get started. I'm going to spend the next 30 minutes or so just running through some areas, and I appreciate that some of you may be listening to this on video, but all the information and advice that I give today will be relevant until the end of 2023. So there is still some time to take action, and we will be running further series of webinars into 2024, but this is the last of those that it will enable you to reduce the tax that you pay this year. For those of you that are not familiar with Alpha Wealth, we're a progressive financial services provider based in Cork and Dublin. We have 10 advisors. I myself have been a financial advisor for over 25 years now, and we operate as an independent brokerage. So today, there's three main takeaways that I want to leave you with. Firstly, what has changed in the financial landscape this year?
Nick, just on that, I suppose I'm going to jump in and just ask you in simple language, can you explain what has changed for senior managers and business owners this year?
Yeah, thanks for the question. I should have mentioned that anyone who would like to ask any questions, and we're going to try and make this as interactive as possible, please do feel free to put into the Q&A any questions that you might have, and we will look to address them throughout the course of the webinar and indeed at the end. In terms of what has changed, this slide probably best explains what has happened since the 1st of January 2023, which is that Revenue are now allowing any senior manager and any business owner to have unlimited payments into their pension scheme up to a lifetime limit of 2.15 million euros without any regard to any form of salary of any description. They just have to be employed by the company, even on a wage of 100 euros a year or more.
But Nick, can I 2.15 million, it seems like an enormous amount of money for a pension pot. Is it? Is it not? Can you give a little bit of context around it?
Yeah, it is a large figure. It's more than people would need to retire successfully and live a comfortable lifestyle, for sure. Having said that, that limit, which is currently twice the limit of our counterparts in the UK, the best pension scheme that anyone in the UK can have is 1.07 million. But the fact of the matter is that if you think about it, if you're in your 40s and if you're on a good salary, and if you have the ability to get your salary diverted somewhat towards a pension scheme, and if you've been in a company for a long time, particularly with one of the bigger pharma companies, for example, where you're on a defined benefit type pension, you might be surprised, but you'll actually find that there are quite a few people that are actually reaching that limit. And I suppose the point I'm trying to get across today, and information is power, is about giving you the best opportunity to reach whatever it is that you can reach at the shortest time possible with the least amount of hurdles in the way. So again, I will look to go through that, but for cash rich companies, for example, if you're in a position where you can put money into a pension scheme for you, possibly your partner, perhaps even, children that you have who are in their kind of teenage years, it absolutely is an opportunity. And it's something that I would strongly recommend that you would consider, because it is an enormous opportunity for you to reduce the tax you pay. I will talk about financial independence and how to achieve that. And then lastly, I'm going to talk about a way in which company owners and anybody that employs people have a way of saving money, particularly for next year. So let me talk about financial independence. Okay, one of the key things that we say to people when we have our first engagement with them is, what financial objectives do you have? And we help them reach their objectives and essentially reach what I call financial independence in the shortest time possible. So what does that mean for most of us? Essentially, notionally, it means retiring. But that doesn't mean that you have to stop working. For most people, I say to them, realistically, I'd like to help them get to age 60 where they don't have to work for financial reasons. They may choose to. I was speaking to a client earlier who said that they're going to work until they die. They enjoy work, and that's absolutely fine. But a point I make to them is that it's more than about choice rather than necessity. Now, that sounds kind of holistic to some of you, but if you set certain goal posts in place for yourself, and as Hazel said on the video at the start of this, for those of you that heard it, the financial budgeter is a really powerful tool. It's available, it's on our website, and it's one of the start and key, I suppose, building blocks towards financial success. And that's something that we certainly would like to think
So
that
Nick,
we can help.
we've the first question in, and it's, what is the benefit for the employer of diverting an employee's salary into a pension?
Okay, that's a great question, and I actually have a slide on that. So this is an illustration of the fact that I'm a company owner myself, and I have the ability to pay bonuses of my staff into either a pension contribution, I give them the choice, or into a salary bonus. If it's a salary increase or a bonus, there's employers PRSI, which for this example of €1,000, and obviously can be prorated up or down, costs a further approximately 11%. So the answer to the question is, the company saves 11% of a payment by the money going into a pension rather than into a bonus payment. On top of that, there is tax relief on the pension contribution. And more importantly, for the employee, they will get full value for the pension payment, which in this case is €1,000, versus getting the tax, which is currently 51% at the higher rate for anyone earning over 42,000 a year from January 2024, that they're going to lose. The biggest cost that we bear in our lifetimes, guys, is tax. And really today is around helping you to reduce that both personally and through your company. And as I said, there are, in my opinion, a really, really powerful tool, which is your pension. You could theoretically have a salary of 20,000 a year and a pension contribution of 150,000 a year. There are no limits anymore. And this changed only for the first time in January of this year.
And Nick, from clients that you've dealt with, would many companies be open to facilitating this kind of arrangement?
Well, it's interesting because, again, because of the change this year, and it is important to get proper advice. It's not just this kind of carte blanche change that took account. There's certain types of pension vehicles that allow for this opportunity. But the point being is that you need to ask your employer. You need to know whether or not they would allow you. And a lot of employers are starting to be more open to this. And all I'd say to all of you is make sure that you've asked the question. And that's really about, again, information is power. What I want to do is just show you now really what, as I say, in terms of these roadmaps that I refer to, setting out, plans for our clients based on their age and whatever financial objectives they have, whether it's to plan towards buying a house or moving up into a bigger property, or whether it's for saving for their children's third level education needs. Obviously, retirement planning, which is part of the discussion piece today. I talk about a sweet spot. how much should you aim for? We spoke about the maximum, which is 2.15 million currently, which could easily be reduced, by the way. And therefore, if you exceed whatever figure the government reduce it by, they can't take it away from you. But for most of us, the first point that you should try and aim for is somewhere between 6 and 800,000 in your pension fund. And you might say, well, how can you give that sort of figure? It seems very loose. I don't do loose, but to explain, if you reach 60 years of age and had a pension fund of 600,000, it would typically manifest as a quarter tax-free to you, which is 150,000 euros, all of which would be tax-free. And the remaining 450,000 euros, you could draw an income of approximately, very conservatively, about 22,500. You can actually draw a bit more because the way people draw their pensions now is that it's variable. You can draw as much or as little as you require and typically staying under the threshold. And when you allow for the state pension, which currently is age 66 in Ireland, and particularly if you've worked in the UK and there's an ability for you to buy UK state pension years, which is something that I would encourage you to explore, and we can explain more to you. I feel for most of us, that would be a fairly good stab at giving us a reasonable retirement income. 800,000, again, you can see from the illustration, is a figure that's often banded around because that allows you to take the maximum amount tax-free, which is a quarter of the 800, which is 200,000. And again, the remainder would give you a fund of somewhere around 36 to 40,000 a year. I appreciate that these are very high level numbers, but let me show you through my own illustration. And this is me on the screen here. I actually just turned 50 a week ago, but for a fund value in my pension scheme that I had accumulated up to date, which is around 220,000, making contributions monthly of around €1,000 a month, which would cost an individual, if they were paying themselves, 600 a month. My contribution is split between my employer and myself, and therefore there's a deduction for the company and a deduction for me. My deduction is at 40%, the company's is at 12.5%, of course. But you can see that the projection based to age 63, which is the age of my youngest child's age of independence, will give me a fund of around 770,000. Allowing for 3% inflation is just over €500,000. I'm somewhere in that middle point of what I suggested would be where you should be aiming for. And of course, if I'm in a position to accelerate that, particularly given the new rules that have taken effect this year, that's going to bring me to that point quicker and possibly, hopefully, exceed that figure, allowing for everything else that can take place. I just want to move on to about getting your money to work harder for you. And essentially, up until about 3 months ago, we had a situation of about 14 years where we couldn't earn any interest from the banks. That has changed. And I would ask all of you, I'd challenge all of you, I'd say, to not accept getting no returns on any money that you have, either personally or in your company, or indeed, monies that you have that you're saving into an account in the bank, credit union, or post office with. This is an example of one of the insurance providers offering a guaranteed fixed return account, no risk, no variation, where if you put money into an account for 3 years as a lump sum, you can earn approximately about 11.4% over that period. It nets out at about 3% per year, which will basically keep pace with inflation. I'm assuming inflation will keep at around 3% a year as a medium to long-term average.
But Nick, should we all be putting money into an account like this?
Potentially. I talk to clients about a menu board. What's the best thing you can do with your money? I don't think this account is the best one. I think it's one of several options. And to give you an example, this account will keep pace broadly with inflation. However, I want myself and for my clients to benefit from returns over and above inflation. That's moving forward rather than just staying still. There are examples of accounts I'm just going to show you briefly here. If you say, for example, had the ability to save monthly, if you have a period of 3 years or more, and I refer to that as a kind of the medium term segue, you can put monies into accounts where you can earn typically 4, 5, 6% a year comfortably. not a guaranteed return, but it will over time, I believe, and I can prove, give you rates of interest over and above that 3% level. This is one example with one of the insurance providers. We set up the Alpha Savings and Investment Club almost 2 years ago, where we select the best provider in the marketplace. Currently, Zurich have an option where they'll allow you to put in monthly contributions. This is personal and company monies, by the way, where you can add to it, you can take from it. It's like a tap. You can turn it up, down, and you can turn it off. You can withdraw from it without any penalties. And we show you what type of accounts are available and what sort of interest you can earn. So, for example, the illustration on the screen there shows a fund called Prisma 4, which we typically the fund that we would advise most of our clients for that sort of 3 to sort of 10-year period, where you can see at the bottom of the screen there on the right-hand side, the average returns that this account has achieved over the last 3, 5, and since launch is about 10 years, somewhere between 4.7 and 6% per year, which is obviously significantly above where deposit and indeed inflation rates are.
What kind of
Again,
risk category, Nick? Oh, sorry, you've just put up the risk profile, but where does Prisma 4 fall when you look at this risk profile?
okay. Do please feel free to continue to ask questions, guys, as well. Sorry, just put them into the Q&A. But one of the main takeaways from today is I really want people to understand the table that's on the screen. And I know it's a bit colorful, but whenever I talk to somebody about money they have, whether it's for buying a house, whether it's for saving for retirement, whether it's for, planning for the third level education fees, I talk about this table. And the longer you have between now and that time period that you need that money for whatever objective, allows you to go higher up this scale. I never want any of my clients to be in the risk category 1, and I never want them to be in risk category 7, both of which have their own issues. 1 is just too conservative, you're going to lose money to inflation. 7 is too volatile. And then it's a case of somewhere in between. So that Prisma 4 fund typically sits in that category risk level 4, where you're looking at returns, as I showed you earlier, and I proved to you, rates between somewhere like 5 to 10% per annum. Obviously, if you've got a longer duration, let's say, for example, my pension, I showed you the 14-year horizon. I'm looking at greater growth, and I therefore have a slightly higher risk tolerance. And I'm putting my money into currently a risk profile 5 account. And I can vary that depending on the individual and obviously the amounts involved. But generally speaking, as I say, it shouldn't be based on what you want to your tolerance to risk is. It's about the time that you have to allow yourself the opportunity to benefit financially and get appropriate advice. And for a lot of you who may have these types of accounts, my suggestion is make sure that you're paying the absolute lowest fees possible, because fees will erode your return. And we can give you independent guidance, whether you have a company pension arrangement, whether you already have a savings plan set up with the likes of Irish Life, Aviva, or so on. Talk to us. We have no bias. I told you we're an independent brokerage, and we'll help you make sure that you have the best account for you and you're taking advantage of all of the tax opportunities. Which brings me on actually to one opportunity that's available personally. So this is personal tax that you pay, regardless of whether you own a business, whether you're a senior manager, whether you're an employee, where you have between now and around the 7th of December to take advantage of a government-backed scheme that you can get 40% back on a contribution towards one of 50 qualifying companies. Now, what do I mean by that? So say, for example, you've got money in the bank that's earning little interest, and you have the ability to put that money into an account for at least 4 years. This scheme runs typically from 4 to say 4.5 years. This, again, slide shows the example of 10,000 euros, the minimum of which is 5,000, that you can invest into one of these qualifying companies and get 40% back from the government, which is 4,000 on this example, with looking around 2,000 profit after that period of 4 years. So if you think about it, that 10,000 contribution that you've made to this company, you're getting 4,000 back from revenue, and you're looking to get 12,000 back from the scheme at the end of 4 years. 10,000 of your own money plus 2,000 of a gain. It's called the EAS scheme, Employment Investment Incentive Scheme. This actually, which hopefully you can see here, is a supplement from the Sunday Business Post last Sunday. And again, I can make this supplement available to anyone, where it profiles and references a number of companies in this space. Our job as independent brokers is to find the best companies out there and show them to our clients. And on the screen now, I'm going to illustrate 3 of them, and I'm going to explain to you 2 of them in a bit more detail. Blacks of Kinsale. It might surprise you to hear about a whiskey company. This is a fabulous company based in Kinsale in Cork, traded since 2013, profits of over 500,000 a year. Just went into a new distillery in Kinsale, a fantastic multi-distillery plant. And what we do is we provide you information, we explain the scheme to you. We actually did a short video both for Blacks and also for 2 Mile, which is the other company that I'm going to mention briefly now. And we explain to you why we feel very strongly that your money should be placed with these companies, and the fact that you can not only avail of the 40% tax rebate, but also benefit from the interest that these companies would reward you with. And again, it's something that, you know, we can explain to you in very simple, you know, detail, and give you the opportunity to research and get more information of. If you know, are wondering what 5 Mile in, 5 Mile is a restaurant rotisserie based in Middleton in Cork. It's been bought by the owners of a company called Clistra, who own a number of hotels and restaurants and bars up and down the country. A fabulous group. They own the Radisson in Little Island, which is very close to where I am currently, alongside a number of other hotels, including the Muckross Park. Traded extremely well during really difficult periods. And they have just bought this restaurant, which they're using as security, by the way, and they're going to turn it into a really, I suppose, great opportunity for people to benefit from their future growth, including 5 Mile Coffee, which you can see on the bottom right-hand side of the screen, which is going to provide a really attractive income stream for investors. Blacks of Kinsale, I mentioned, you can see there the distillery that they've just finished. It has now been fully completed and the car park is fully fitted out. It's a fabulous company again, and I would encourage people to consider this as an opportunity to reduce the tax that you've paid this year. This is one of 2 opportunities that I personally would seriously consider. I'm now going to just talk to you briefly about something called auto-enrollment, and my colleague Ruth, and thank you for those of you that did answer the poll question earlier, but she's going to launch a poll just in relation to this. But what I'd challenge you with is, do you know what auto-enrollment is? Auto-enrollment is really where the government are going to force all companies, and they've suggested the 1st of September next year being the latest time that they're going to put this in play by, where you're going to have a pension for all staff, as long as they are 23 years or older and earning 20,000 a year. Now, if you think about it, this is going to be an enormous cost to companies. And you might say, well, okay, but my company has a pension scheme in place. It won't qualify if not all members of staff are entered into the scheme. Now, this part of the presentation is really geared towards companies that don't have a pension scheme. So if you're an employee and your company doesn't pay into your pension, they may have offered you a facility. You're going to be auto-enrolled. Typically, by the time this comes into effect, we think the 1st of September next year, unless you do something about it. And being auto-enrolled, by the way, in my opinion, is not an attractive opportunity. And the reason I say that is because what is auto-enrollment? The company is going to have to pay 1.5% of the employee's salary into this pension, has no choice about where it goes. You're being mandated into whichever companies the government chooses. And 1.5% of the salary may not seem like a lot. The problem with that, though, is every 3 years it's going to increase. 3 years later, it's going to be 3%. 3 years after that, 4.5%. 3 years after that, 6%. So 9 years from the introduction of the scheme, you're going to have all employees at a 6% contribution rate. Now, the employees might be happy about that, The problem is, though, they're going to have to pay the same contribution. So this 23-year-old that's earning 20,000 a year is going to have to pay 6% of their salary into a pension. They may not want to do that. The other problem with auto enrollment is that there's no flexibility around payments. You cannot pay in more, you cannot pay in less. On top of that, there is no provision for early access to the pension. All people that are in a company pension arrangement can access it no later than 60 and typically from the age of 50 onwards. Auto enrollment does not allow for that. You have to take it at state pension age, which is currently 66. And lastly, and probably the most biggest problem about auto enrollment is you only get tax relief at the lower rate. And if you're an employee that's earning over 42,000 a year from January 2024, you're going to lose out on the difference of the standard and higher rate. It wouldn't be advisable at all. So therefore, really what I'm saying is, from a company's perspective, don't be auto-enrolled. From an employee's perspective, don't be auto-enrolled. And I can show you, and I'm doing a webinar on the 11th of January, 2024. My colleague is going to put up actually how to access that. But more importantly is talk to us. Myself and my colleague David Looney can go through with you the options around how to avoid auto-enrollment, both for the company and also for the employee. I just want to touch on a couple of other points. And again, it says for company owners, but it's also relevant to directors and indeed senior managers. I come across a lot of company owners or senior managers that are paying a lot of money for personal insurances that they endure themselves. And I say to them, but you have benefits for your company? Why don't you get your company to pay for your life insurance? Why don't you get your company to pay for serious illness for you? And I know some of you might be sitting there saying, well, my company's not going to do that. I explained to you the opportunity around pensions. It's the same opportunity in relation to life assurance. If your company is open to providing life assurance for you, they will get tax relief. You will receive the full benefit, or more correctly, your estate will, if in the event of passing. But for serious illness, you can get your company to afford you that ability. Same for income protection. And I really think this is an opportunity that a lot of senior managers and business owners completely miss out on. And again, I can go through that with you. The last two takeaways I just wanted to mention are, if you are, and again, I became an accidental business owner about 10 years ago. We're actually going to have our 10th anniversary early next year. But for anyone who's in their sort of early 40s, or indeed from 45 to 55 years of age, that is a business owner or may become one, there are two things that you should know. Firstly, that you can sell your company from the age of 55 onwards at a reduced tax relief for the first €1 million of proceeds. It's something called entrepreneurial relief. The second thing, though, and probably more relevant one, is that you can extract up to 750,000 from your company tax-free from monies that you leave in the company. And this is relevant to the fact that if you have a business, even if you already just started your business, you can start planning. And the key thing about financial advice, guys, and planning is that you need to firstly adapt your plan as your situation changes. You know, I've gone from working in the UK to working in Ireland, set up my own company, as you know, 10 years ago. Lots of things have changed financially for me, and it's about navigating that and having your plan and making sure that you are checking in with a professional advisor. The cost of dealing with an advisor, by the way, and I'm going to go into this now with you. Typically, we charge €99. It's normally 199. We are discounting that for anyone who is listening to this call, or indeed does use the code Alpha50, which we're going to make available until the 7th of December this year. And we will save you thousands. I've given you some indications of where we can save people money by setting this financial roadmap for them, showing you how you can reduce costs that you endure, not just in protection policies, but also making sure that you're doing the best with your pension, reducing the tax you pay, taking advantage of schemes like the Employment Investment Incentive Scheme, and doing ongoing reviews with you at no further charge. Now, if anyone wants to reach out to me or has any questions, please do pop me an email. My email address is there on the screen. It's very simple, just nick@alphawealth.ie. follow us on social media. There's lots of free webinars that we provide. There's lots of videos that you can access through Alpha Wealth. And we are continuing to do further webinars of this type. But I would honestly encourage you all, do consider whether you're in a position to avail of the EIS opportunity this year. So last year that you can get relief of 40%. It will continue into next year, but I do think it's certainly worthwhile exploring. That's everything I wanted to cover off today. If anyone has any questions, please do feel free to pop them into the Q&A. Clean, I'm not sure if there are any other
Yeah,
questions.
there is. So, firstly, the slide where you referred to the sweet spot for a pension pot of between 600 and 800k, was that aim for per person or for a couple?
That's a good question. So it depends really. And for example, some of you may be in a relationship with someone where they may either not be working, they may be earning more money and have a bigger pension pot than you do. You may treat your finances slightly separately or combine them. There's no right or wrong either which. I suppose what I would say to you is that, again, check your own situation. It's worthwhile. And again, our financial reviews do allow for partners, and we would conduct these typically, if appropriate, with a partner. But what we would say to you is you should, in isolation, on your own, aim certainly at the low end of that scale. Now, obviously, if you don't have the provision to, or indeed, if you don't have the income to offset, there is no point trying to aim for those sorts of figures. But the short, I suppose, answer to your question is it would be 800,000 as a collective, probably closer to 400,000 as an individual, as a minimum, typically, that I would suggest would give a household the ability to not have to work, basically.
And I know you spoke obviously about kind of risk profiling and obviously very dependent on what age somebody is, but is now a time to consider maybe de-risking your pension a little bit or leaving it where it is?
It's a question I get asked a lot, which is, people hear the news, obviously, and the news tends to be very negative. They only talk about when markets go down and not when they go up. The key thing about, your investment life cycle, guys, is that try not to time the market. Nobody, and I mean nobody, including the likes of Warren Buffett, can time the market perfectly. The point is, think what I said earlier about, how long you have, and that should dictate the risk that you should accept. Of course, if you have 100,000 euros to invest, you're going to be a bit more discursive than if you're saving 100 euros a month. But what I would say to you is that don't try and second guess things. Don't go into a cash fund because you're worried about market conditions. It will be the worst thing that you can do. Get professional advice would be the short answer to helping you to make sure that your money is working as effectively as it can be.
And is there any benefit to taking the other 75% of your pension as a lump sum?
In short, no. Typically, the way that we all draw our pensions now is that we take our 25% tax-free, the 75% goes into a fund, the same fund that you're in typically at the moment, and it continues to grow for you. The key point about your post-retirement income, guys, is keep it at the standard rate wherever possible. You could draw your 75% balance out, but the reality is you're going to pay 52% on the vast proportion of it. It would be crucifying, and typically it's not something you should look to aim to do. Having said that, if you have several pensions and it's important to get someone to review them for you, you can access certain pensions, as I mentioned earlier, from the age of 50, and it may suit you to actually do that. So if you said, Nick, I have a pension from a previous employment, it's worth about 20,000 euros, but I don't know where it is. We get details of that for you, and I can show you how you could potentially access that at age 50, which may help you pay down your mortgage. It may help you finance your kids through college. And things like that certainly would be worth exploring.
That's it in terms of the questions. There aren't any more coming through. So I'll hand it over to you to wrap it up.
Great. Well, thank you very much again for listening to today's webinar. I will send an email out just with the video. And also a couple of the links that I think would be worthwhile. I mentioned the financial budget earlier. Also, we are looking for feedback for these webinars, certainly into 2024. If anyone could spare us the 20 or 30 seconds just to complete that, we would very much appreciate it. Again, I would encourage all of you to explore the EAAS opportunity further. I think it's a really valuable option for anyone who is paying tax at the high rate and has at least 5,000 euros that they can put towards that as a complement to your pensions, of course. And as I said, we'd love to hear back from you. And if you have a question, please don't hesitate to pop me an email. I'm more than happy to answer that. Thank you so much again for your time. And for anyone who's listened to this on playback, again, please do feel free to reach out to us and use the discount code Alpha50 to avail, obviously, of the discounted review. Thank you so much for your time. And as I said, we look forward to speaking to you over the course of the next couple of weeks. Thanks.